Bloomberg Audio Studios.
Podcasts, radio, news.
We begin this hour with our top story. No news is good news. Stocks edging higher. As Chairman Powell touts Congress, he's expecting rate cuts this year, even as a strong economy keeps the Fed on hold for now. Oaktree's Howard Marks writing this in his latest memo. I find it interesting that the current stock market rally began as a result of optimism powered by consensus thinking that was generally off target. Investors motivated by their belief that the Fed would pivot to dovishness and start cutting rates in 23. That was wrong. We'll get into consensus in just a moment. The legendary Howard Marks joins us around the table. Howard, good morning to you.
Good morning, Jonathan.
Fantastic memo. Really enjoyed the read earlier this year. Easy money. You reflect on the easier times fueled by easy money, lulling investors into a false sense of intellectual superiority. I want to know, and I think Lisa wants to know too, have we fully realised the pain associated with some of the loans, some of the things we did 10 years ago?
No, clearly not. It's early. The economy is still good. That keeps shaky loans aloft. The maturities, any company that was not asleep at the switch pushed off its debt maturities in 2021, 22, when rates were still close to zero, pushed them off. So the maturities start for real in 25. There are not substantial maturities this year. And, there are three ways you can default. You can breach a covenant that specifies levels for your financial statements. You can fail to make an interest payment, or you can fail to meet a maturity. Well, the eager lenders let companies exclude covenants in recent years, so you can't do that. Interest rates mean that the coupons are low, interest coupons are low, so it's hard to miss one of those. And in a positive climate, you can borrow to make your interest payments. So we're really talking about maturities which have been pushed off to next year. And if you get maturities spiking in a weak economic period or weak for certain groups, that's when you get defaults. They're still running low.
A lot of people have come on this show, Howard, and said that this market is discerning. It's not necessarily just buying everything with abandon. It isn't exuberant. There isn't euphoria. There's sort of a separation of those zombies or those that are likely to default in 25 that can't survive until 2025 and those that can't. Do you agree with that?
I generally do. This is not... The crazy markets are few and far between. When you get a real soaring bull market, a bubble, or a crash, those are when they stop being discerning and, as we say, throw out the baby with the bathwater. Most of the time, markets are sane, especially a market like this, which is being buffeted by good news and bad news at the same time. So, I think we're in the middle ground. I've been saying for a long time that we're in what I call the zone of reasonableness, and I don't think there's anything much to do.
Zone of reasonableness, and I want to get into that there's not much to do, but a zone of reasonableness where there's a strong consensus, and you pointed to, and John led with, this idea that consensus last year was completely wrong. So this year you said there's a feeling that smacks of Goldilocks thinking. How do you work with that as an investor?
Okay, I don't think the consensus is necessarily not wrong. I just think that most people can't improve upon it. That's really the criterion. What I learned in school, the efficient market hypothesis, markets are efficient. That doesn't mean they're right. That just means that most people can't improve upon the market's consensus judgments. So now tell me your question.
Well, I guess that I'm wondering, where are we in the cycle, in the credit cycle?
Following from Jonathan's question, Buffett says it best: when the tide goes out, we find out who's been swimming naked. The tide hasn't gone out. We're still in generally salutary period. Economy functioning well, earnings pretty good, interest rates coming down recently, money available. So under those conditions, you don't have a test. The question is, which companies and industries do okay when conditions get tougher?
Can we work through some of the more quotes in this memo as well? There's this great line, and you've said it's an old line, but I still love it. The worst of loans made at the best of times. Yeah. This quote from you: I love Hayek's word malinvestment because of the validity of the idea behind it. In low return times, investments are made that shouldn't be made. Buildings are built that shouldn't be built? Can we talk about buildings that were built that shouldn't have been built? Is that an area of focus for you at the moment as you think about prospective weakness down the road?
Well, I think that commercial real estate, office buildings in big cities in particular, are a focus area for investment people. The post-pandemic behavior of people not going to the office so regularly calls the sector into question, as does AI and the question of how many employees you're going to have. Or am I going to be talking in 5 years to a machine over there? I don't know.
Maybe you are right now.
There you go.
Maybe this is AI right now.
Lisa topped me as always. So I mean, there are questions about real estate. But on the other hand, most people won't touch real estate with a 10-foot pole, and they may be underestimating the intrinsic value. So that, Jonathan, it's important that everybody understand. The question is not, is everything going great in a sector, or is it going terribly in a sector? The question is, do prices in that sector reflect the reality, overestimated or underestimated? I've made a living buying things that nobody else thought was a good idea, but if you buy them cheap enough, they become a good idea. And if you have the right real estate in the right place, if you're differentiating and other people haven't,
yep,
then that's a time for bargain hunting.
So you've got the story and the price of the story. Can I ask if you like the price of the story?
There's not a lot of price discovery going on in the real estate industry. There are very few transactions. So when you say, do I like the price of the story? I don't see a lot of prices. In order, I see, people say, it's not worth anything. But where will they trade? If the quoted price for a New York office building is down 50%, let's say, will any sellers sell there? Will all the buyers buy there? If a lot of people are willing to buy and nobody's willing to sell, that says to me the real price isn't down 50. So we have to have price discovery.
Which it brings us to kind of the fact that the tide hasn't gone out yet.
Exactly.
And that when the tide goes out, then we're going to start to get some real price discovery, because then there will be some people left naked. You don't like to make rate projections. You do have a model roughly in your head where you say in the memo that you don't think that rates are high. They're kind of more normal.
They're not high relative to my experience.
So if that's the case, you kind of game out a 3 to 3.5% Fed funds rate over the next 5 to 10 years. What then does that mean for returns just more generally? Does that mean that they're better in credit and better in your world? Or are they kind of worse because the overhang that we've had of the easy money policies is going to take a lot to work through?
It's a complex question. But those, we're at 5.25 to 5.5 on the Fed funds rate now. That's a measure determined to crimp the economy to kill off the excess inflation. The target is 2, we're above 2, cool off the economy until it moves toward 2. By the way, in Powell's remarks on Monday, he said, we won't cut rates until we see we're making progress toward 2%. I thought that the word toward was very important. He didn't say until we're at 2%. So I think that, if inflation starts going, 3, 2 3/4, 2.5, maybe he'll start cutting. I don't know. But the word toward was important. The only thing I'm sure of is that if interest rates are higher, the people who invest in credit instruments, which is what we do, are buying in at higher yields and invariably will have higher returns than they have in the recent past. So today's rates are not high historically, but they're certainly higher than we had from 2009 through 21, which means the returns on credit investing, fixed income investing, bond investing, loan investing, will be higher than those in that period, which were, really paltry.
Howard, always super thoughtful, and the brilliant Howard Marks.